Welcome back to the Daily Crypto Deep Dive. Today we're not talking about a price pump or an ETF filing or another influencer prediction. We're talking about a scenario that would rewrite the structure of global power itself. A shift so large it would make every previous bull run look like a footnote. What would happen if the world's second largest economy, China, decided to quietly rotate even a fraction of its massive US bond reserves into Bitcoin? It sounds like a fantasy. But when you start to run the numbers and look at what's happening behind closed doors in the global bond market right now, it suddenly doesn't seem impossible at all. In fact, it might already be starting. To understand the magnitude of this, you have to look at what sits underneath the entire financial system. The United States government owes more than $37 trillion. Roughly 1/3 of that debt is held by foreign governments, central banks, and sovereign funds. China alone holds about $770 billion in US Treasuries, down from over $1.1 trillion just 5 years ago. Japan holds about $1 trillion. The rest is spread across Europe, the Gulf states, and the BRICS alliance. Those bonds have always been the anchor of global savings, the safest place to park surplus cash. But now, the world's biggest creditors are starting to look at that safety differently. In the last 12 months, the yield on 10-year Treasuries has hovered near 5%, the highest in nearly 2 decades. At the same time, the dollar index has stayed strong, which means countries holding that debt have seen their own currencies weaken and their reserves shrink in real terms. And behind those numbers lies a much bigger problem: trust. When Washington weaponized the dollar through sanctions after the invasion of Ukraine, freezing hundreds of billions in Russian reserves, every finance minister on earth took notice. For the first time, nations realized that the US could, and would, lock them out of the system if it wanted to. And once you understand that your reserves aren't really yours, the search for alternatives begins. That's where Bitcoin quietly re-enters the story. Not as a speculative asset or a hedge for tech-savvy investors, but as a neutral, censorship-resistant store of value on a global scale. Analysts at Fidelity and ARK Invest have both modeled scenarios where even a small central bank allocation to Bitcoin, say 1% of global reserves, could push the price above $200,000. If a country like China were to diversify 5% of its US bond holdings into Bitcoin, that single move would absorb nearly the entire annual supply of mined coins. That's not hyperbole. It's arithmetic. There are only about 900 new Bitcoins created every day. That's less than $1 billion a month at current prices. If Beijing suddenly needed to move 30 or 40 billion into digital gold, the market couldn't handle it without a vertical repricing. Now, let's step back and ask the obvious question. Would China ever do it? On the surface, the answer looks like no. The Chinese government has banned domestic crypto trading, shut down mining operations, and promotes its own centralized digital yuan. But dig deeper and you find contradictions. Beijing's state-owned banks are testing blockchain settlement systems with Hong Kong partners. Chinese tech giants like Tencent and Alibaba are patenting tokenization protocols that look suspiciously similar to public chain infrastructure. And perhaps most tellingly, China's gold reserves have been climbing month after month for over 2 years. Officially, they hold around 2,000 tons. Unofficially, analysts believe it could be closer to 5,000. Why? Because gold and Bitcoin serve the same strategic purpose: insurance against the dollar. And when a nation stockpiles one, it's usually not blind to the potential of the other. Imagine the ripple effect if Beijing began reducing treasury purchases and reallocating even a small portion into Bitcoin or other decentralized assets. The message to the rest of the world would be deafening. It would signal that the dollar's monopoly as a reserve asset is no longer absolute. Other BRICS members, Brazil, Russia, India, South Africa, have already floated the idea of a shared digital settlement currency backed by commodities. If that experiment gained traction and integrated Bitcoin liquidity for cross-border trade, we'd be witnessing the first genuine competition to the dollar system since 1944. So, let's explore the mechanics of how such a rotation could unfold. China doesn't need to make a dramatic public announcement. It could diversify through state-linked investment vehicles in Hong Kong, using intermediaries in Singapore or the UAE. Those funds could accumulate exposure through ETFs, over-the-counter desks, or direct custody arrangements with friendly jurisdictions. It could even happen through commodity swaps, selling US bonds to purchase tokenized gold or Bitcoin via offshore clearinghouses. In practice, it would look like any other portfolio rebalancing. But on-chain, we'd start to see unusual accumulation patterns. Large wallets linked to Asian time zones steadily absorbing supply. Glassnode analysts already track similar behavior during periods of yuan weakness, suggesting that Chinese capital, state or private, is finding its way into crypto even now. The geopolitical implications are enormous. US Treasuries are the backbone of the American financial empire. If demand for them falls meaningfully, yields rise, debt service costs climb, and Washington's ability to finance its deficits erodes. Every 10-year yield spike of 1% adds roughly $300 billion a year to interest expenses. At some point, that becomes unsustainable. That's why the Federal Reserve has quietly become the buyer of last resort. It issues money to buy the very debt the government creates. And that feedback loop, printing to fund debt, is what historically ends every empire's monetary cycle. It happened to the British pound after World War II. It happened to the Dutch guilder before that. And history suggests the same trajectory for the dollar. Now, let's inject realism. Would China really dump its entire $700 billion in treasuries overnight? No. It would be economic suicide. The value of those holdings would collapse before it could sell them. What's more plausible is a slow migration, a few percentage points a year, redirected toward alternative stores of value. That's already happening. Over the last decade, China has reduced its US bond exposure by nearly 30%, while expanding positions in commodities, infrastructure projects, and regional currency swap lines. Bitcoin could simply be the next, logical layer, discrete, portable, and increasingly liquid. Some Western economists still scoff at the idea, saying Bitcoin's volatility makes it unusable as a reserve. But volatility is relative. In 2025, US sovereign bonds fell more than 10% in real terms. Worse performance than Bitcoin in the same period. When the supposedly safe asset loses value faster than the risky one, narratives begin to crack. Even the IMF has started to acknowledge this shift. A recent report noted that digital assets may play a growing role in cross-border settlements, particularly in regions facing currency mismatches. Translated from IMF language, that means the door is open. And it's not just BRICS nations testing the waters. The Middle East is experimenting with oil payments in yuan, rupees, and even stablecoins. African nations are exploring regional digital currencies backed by gold. Latin America is building Bitcoin-based remittance rails that bypass the US banking system entirely. Each of these trends chips away at the idea that you need the dollar to trade, settle, or save. When you connect those dots, you see the outline of a parallel system forming. Decentralized, multipolar, and ultimately, inevitable. For Bitcoin, the consequences would be historic. Right now, its market capitalization hovers around $2.2 trillion. If even $1 trillion in global reserves migrated into it, that figure would likely double or triple overnight. The supply shock alone could send prices into territory we haven't dared to imagine. But beyond price, it would mark a psychological shift, from crypto as speculation to crypto as statecraft. Let's play out the timeline. Step 1. Small sovereign funds and central banks start adding tiny Bitcoin allocations under the banner of diversification. Step 2. Settlement networks like Russia's SPFS or China's CIPS integrate blockchain ledgers for interbank communication. Step 3. BRICS nations announce a commodity-backed digital settlement unit that includes optional Bitcoin reserves as collateral. And Step 4. Private markets, from energy to shipping, begin accepting that unit in parallel with dollars. That's how revolutions happen in finance. Quietly, step by step, until one day you realize the old system isn't the only one left standing. None of this happens without resistance. Washington would fight tooth and nail to defend the dollar's supremacy. It could impose capital control sanctions, restrict ETF access, or classify state-level Bitcoin use as economic warfare. But as history shows, control only accelerates innovation. Every barrier sparks a workaround. And Bitcoin, by design, was built for exactly this scenario: value transfer without permission. This brings us to the personal level. If sovereign nations are hedging against fiat risk, what does that mean for individuals? It means the same logic applies at every scale. When trust erodes in centralized promises, people seek alternatives they can actually own. Gold once served that role. Now Bitcoin does. And if this slow geopolitical migration continues, the biggest wealth transfer in history won't happen between generations. It'll happen between systems. Here's what analysts are watching next. 1. Continued treasury divestment from China and Japan. 2. Rising central bank gold purchases paired with stablecoin experimentation. 3. On-chain accumulation by wallets that match Asian trading hours. And 4. Policy shifts around the BRICS summit in December, where a new cross-border settlement framework is expected to be unveiled. If any of those dominoes fall, the probability of Bitcoin entering the reserve conversation jumps dramatically. So, could China really dump US bonds for Bitcoin? Not all at once. But could it gradually reprice the system by reallocating even 5% of its reserves into digital assets? Absolutely. And if it did, that 5% move would be enough to change the world. Because the real shock wouldn't be financial. It would be psychological. It would signal that the global store of value no longer belongs to any one nation. It belongs to whoever can secure it, validate it, and believe in it. That's the essence of Bitcoin, a network of trust replacing a hierarchy of power. So as we close to deep dive, remember this: empires fall not when they lose wars, but when they lose confidence in their money. The dollar has ruled for 80 years. It survived wars, crises, and revolutions. But history never makes exceptions. Every century, the world rewrites the rules of value. And maybe, just maybe, we're living in the chapter where code replaces credit. Drop your thoughts in the comments. Follow the show. Leave that 5-star rating. And as always, we'll see you at the top.